All right, everybody. I think we're going to start this panel. We'll appreciate everyone being here today. I think this is close to the end of the show, or maybe another day or two left. I'm not sure, but I know you guys have all been here a couple days, so appreciate it. My name is Sudha, Reddy, and I'm the founder and managing principal of Haven Realty Capital.
I'm Chris Turitto. I run investments and acquisitions for Haven Realty Capital.
And just a little bit about the company. So Haven was founded in 2010, based in Los Angeles, and we sort of started our business building a platform to acquire, renovate, lease, and manage single-family rental homes. So, 2010 was 12 years ago now. The world was in a different place. We hope it doesn't go back there again, but it was a moment in time where there was a lot of distress in the marketplace. And we built our firm to go out and buy and own rental homes. And we got to a peak of about 10,000 homes across 6 states, including the great state of Texas here. And so since then, the Sfr industry has really gone through a major transformation. I'm sure most of you are aware of sort of the increase in rental homes by investors across the country, and certainly serving a need. But in terms of the evolution, SFR was a distressed sort of industry, and now it's really a true long-term business. And one of the segments in the business is something that is now known as build to rent. I guess that's sort of just an industry name, but I'm sure it'll evolve over time. But so that's what we're here to do. Is we're here to talk to you guys about the build to rent business, and hopefully you guys learn a few tidbits out of this presentation. We happen to be one of the industry leaders. We own and control over $1 billion in rental communities. That is 34 communities across 9 states. And we've sort of amassed that portfolio over, call it, the last 24 months. We are very, very, very builder centric. And so we work very closely with home builders and partner with them to sort of execute on these communities. So we're really here today to walk you through the industry. Tyler, let's go to the contents. We're going to really start with, I'm going to walk you through the evolution of the business. Chris will walk you through sort of what is build for rent. I know there's a lot of people out there wondering, what does it really mean? What does it consist of? I'll come in and talk to you a little bit about the public home builders that are involved in the business, walk you through the build to rent markets that are pretty popular out there. Chris will walk you through deal structures and product specs. That should help you better understand how some of these deals are made in the marketplace. And I'll finish a little bit with supply and demand, and hopefully there's some time left over for Q&A. Next slide, Tyler. Next one. All right, so SFR Rental Evolution. If you recall, there have been single-family rental homes in this country for as long as we can all probably remember. It has been in the past really a mom and pop business. Families own a home, they move up to another home, they rent the other home out, or someone passes away and passes down a home, that home becomes a rental. That's sort of been the business up until, call it, 2009. 2009, when there was basically the Great Depression or the Great Global Financial Crisis, created a big market of foreclosures. And that's when investors of all different types, including us, went out and sort of acquired homes, renovated them, and leased them out. And that was sort of phase one of this industry. It was really done at a distressed time, but from 2010 to 15, it was really 5 years of true aggregation. And then from 2015 to 2020, it really became about operations and proving that you could have rental portfolios that could offer cash flow and a good return to investors. And sort of that's what has happened. As you all know, COVID hit in the fourth quarter of 2019. And all of a sudden you had a number of young couples and families sort of move to the suburbs and want more space and wanted to rent homes. And so all of a sudden you had investors recognizing that was happening and started to try to figure out, well, how do we sort of offer the supply to meet the demand? And one of the ways this is being done by groups like us and others is to really create communities of rental homes, right? So again, there used to be the ability to rent a home here and there. You could obviously rent an apartment building or a unit in an apartment building. There's never really been a moment in time where you could drive into a subdivision that was all for rent. And this sort of felt to us like the next step of the business. And so there you have it. You've got now something called build to rent, or what we call dedicated rental communities that look and feel like for sale homes. And Chris can talk a little bit about now really what is the definition of build to rent.
Yeah, you can go to the next slide.
And the next one after that.
Yeah. So as Sudha mentioned, this kind of all started with investors buying individual homes. The home in the top left corner up there is just a single family home that one of the public REITs owns and leases out to an individual, and generally those homes are anywhere from 5 to 10 to 20, 30 years old, existing homes, and so that was kind of how it all started. This kind of evolved as home builders saw these public companies out there. Home builders started reaching out to them and selling maybe the last 10 to 20 units of a subdivision to close out a subdivision to these rental companies. So then they were buying some newer homes that they could then offer to rent out. The natural progression there was moving to whole communities that were designed and built as rentals. So BTR, or dedicated rental communities, was kind of the natural evolution from there, as home builders and these rental operators started talking and discussing these opportunities. You can turn to the next slide. So build for rent is kind of a generic term. It's not a great term either. Technically, multifamily is build for rent. So it's this kind of generic term that everyone throws around. But what it really breaks down to is kind of a couple different product types. I think the first product type that people refer to as build for rent is horizontal multifamily. So what horizontal multifamily is it's really detached multifamily units. So it's communities. So if you go to the next slide. Go back one more slide. Keep backwards. Yeah, okay. So the bottom right-hand corner, so that would be what you consider a horizontal multifamily. You build 1 bedroom, 2 bedroom, 3 bedroom units. They're detached units, so no one's kind of sharing walls. But it's the same square footage. 1 bedroom unit's 700 square feet. A 2 bedrooms, 1,000 square foot. So 1,200 square foot, 3 bedrooms. There's no attached garages. Generally surface parked. So it's very similar to multifamily living, only you kind of have your own detached unit. These are very prevalent in the Phoenix market. You're starting to see more of these built in Texas. They generally have, the tenants who reside there generally are very similar to the demographics on multifamily. They stay a little shorter. It's usually some young millennials or single people. So it's very similar to multifamily, but it's a slightly hybrid product to multifamily. The other two products, which is more what Haven focuses on, are the dedicated rental communities, and that's either attached townhomes or single-family detached homes. So these communities would look no different than, so the top far right would be an example of one of those communities. These look very similar in fact, we pride ourselves on our community looking and feeling like a for sale community. So if you were to drive through the community, you wouldn't see any difference from a for sale community. In fact, it would look very similar. In fact, some of the communities that we've acquired from builders, when they started developing them, they were going for sale, and they decided for various reasons to want to sell the whole community to us. This is the resident base there is generally family oriented. The unit sizes are generally, I would say 80% or 95% are 3 and 4 bedroom units. You might have some 2 bedrooms mixed in there, maybe some 5 bedrooms, but so more space, places for families to raise their family, places for families to keep all their stuff. Generally our preference is 2-car garages. So that's kind of the different product types within Build for Rent. You can go to the next slide. Next slide. So for these communities, some of the benefits for renters in these communities are, these are professionally managed. Some of the benefits to communities are also that, all the residents that we put in these communities are screened. So if you think about it, builders, when they sell things for sale, you generally focus on whether this person can qualify for their mortgage. When we screen a resident, we actually do background checks. So it's a much more intense screening process. And because we're owning these assets, we're going to be maintaining these things. Our residents generally stay about 3 years. So it's an extremely safe environment. Some have on-site management. I think one of the other great benefits to renters is it's a maintenance-free environment. So we handle all the landscaping. So while the majority of our residents are millennials, we have anywhere from 15 to 25% of our residents being retirees. They want to live and still, stay in the communities that they raise their families, but maybe they had a 3,000, 4,000 square foot house on half an acre. That's a lot to maintain, and when it's just you and your husband or you and your wife, the idea of being able to live in that same community with a maintenance-free home is very appealing. This is also kind of the first time in history that you can go out and rent, as Sudha mentioned, you can rent new homes. So that's one of the benefits. The other thing is that a lot of these communities tend to have amenities, whether it's a pool or walking trails or dog parks. So we provide a lot of these things, not too dissimilar to the multifamily properties.
And just to add, Chris, I think one of the I think maybe misnomers about these communities is, I think the general public has some sort of feeling about a community that's a rental, right? And the reality is, I think what municipalities are going to find out is over time, these communities are going to actually be better kept than a lot of homeowner subdivisions, because in homeowner subdivisions, as you know, not every homeowner keeps up their property. But in a community like this, you're going to have one owner maintaining every property, and you should have a lot more uniformity. And I think that'll also appeal to renters who otherwise have really had an opportunity to rent in a neighborhood where the neighborhood may not be perfectly kept the same. So I just think that's something that over time the industry is going to have to prove out.
Yeah. You can go to the next slide. So benefits to builders in partnering with groups like us. I think this has varied over time. I think we've seen, obviously for the last 2 years, we've seen an extremely strong for sale market. Quite honestly, I think Sudha and I would say that we never expected to be as popular an option for builders in a strong for sale market. We always thought that we might be a better option for them, either in a declining demand market, or if there's declining prices. I think that's where we thought we would be, advantageous to builders. I think what we're starting to see that now as the for sale market has softened. We're starting to see builders value a well-capitalized group like ourselves who can acquire a whole community at a fixed price and kind of lock in, the builder's pricing. So that's definitely one of the benefits to builders. I think the other thing is that, when we work with builders here, so we don't do any vertical construction ourselves. We generally all of our selections are within a builder's buy box and option box. So when we put one of our properties or one of the communities under contract, we go through and spec out the whole community prior to them going vertical on anything. So there's a real opportunity here to align your subs and build your schedule with a true even flow process. So you know ahead of time exactly what's going in every unit, what color palettes, what options, all those things. So it's already pre-spec'd out before you pour the first foundation. So it really gives an ability to lock in the subs and keep them on site the whole time. There's savings on sales costs, marketing costs. The other thing is that the back office, when you're selling for sale homes, and if you offer options, there's a large option group that would need to take care of this throughout the project. We can eliminate that on certain projects. The ability to decrease the risk of the for sale buyer on our projects. We also, we have the ability where if you have a 100-unit community and you're modeling kind of 4 units to 4 to 5 units a month absorption, we have the ability to take down 8 to 10 units a month, so we can really shorten the duration on a builder's build cycle in a community. That's obviously been a challenge over the last 2 years with the supply chain the way it is, but it's still a greater absorption than generally on the for sale side. I think, and then the other opportunity is that a lot of builders have land positions, maybe multiple land positions in one submarket. If you want to build a for rent and a for sale community, within the same submarket, you're not going to hurt your absorption on the for sale side because it's two different target markets. So you can actually have the scale with your subs and maybe pull forward a project that was going to be 2 to 3 years out after you sold through the first project. You can actually go ahead and build 200 units at the same time in the same market without hurting your own absorption on the for sale side. So those are some of the benefits to the builders that that they're taking advantage of now in the industry. I think we're next slide.
All right, that's me. So I'm assuming some of you are familiar a little bit with the business and the industry. You've probably heard that there are a number of public builders who have announced that they're sort of pursuing different strategies in the sector. D.R. Horton, and what's interesting is not everyone's doing the same thing. And I think that's what makes this business fascinating is there's so many different ways to be involved in it. Small builders, regional builders, multi-generational, single market family builders, all the way to publics. And so what you see here is Horton is probably the largest group doing this. They're actually building entire communities, leasing them all up and selling them sort of like an apartment building. That is one way to do it. That obviously requires a very large balance sheet and an ability to sort of hold your capital all the way through, right? Typically, home builders are looking to buy land, build, and sort of cycle through. And so they have a sort of capital stack that allows them to hold all the way through. Lennar is a group that's doing a little bit of both. So they're building communities and selling them to groups like us. They're building communities and retaining them and leasing them. They've announced sort of having their own quote unquote sort of SFR or build to rent group. So that's, again, another large public company, great balance sheet, has the ability to sort of take something from A to Z. Taylor Morrison's a great group. I see some folks here from Taylor Morrison. They're definitely entering the sector and trying different things. They've invested in and partnered with one of the sort of horizontal multifamily groups that Chris mentioned called Christopher Todd, which is different than their for sale business. It's more of that cottage style, but they're also working with groups like us to sell sort of communities in whole. They're testing it out. Pulte's another group. They've announced a fairly large partnership with Invitation Homes, which is a large single-family rental REIT, to go out and build communities for this group. And so you're starting to see more and more of that. And I think over time, everyone will end up in this sector in some way, shape, or form. And if you think about it, it's really just an additional sales channel. Groups like us aren't necessarily looking to cannibalize a builder's for sale pipeline or take them away from the for sale business. But as you all know, the home building business is cyclical. It goes up and down. We truly believe that we can help create the floor in a down market for builders. Because as you know, listen, in a market where either like for today's market is becoming sort of unaffordable. You've got interest rates on purpose have been pushed up to sort of slow everything down, and it's actually happening in the marketplace. And so what happens now? All of these folks who are living in a home today, maybe they're renting it, they're just gonna rent longer, or if they've made a decision to buy a home and they're living in an apartment, they're probably gonna say, hey, maybe we should go rent a home, right? So I see this as a moment where the build-to-rent industry can show home builders that there's an alternative way to do business, especially as the market slows down.
Yeah,
I don't think we'll be the ultimate panacea for something that ends up being a very, very large recession, but something that I think is modest or moderate. I think we're there because we are absolutely buyers during this moment where we believe that the rental demand is going to be even higher than it was in a normal market. Let's
yeah,
try
I mean, I would
next.
say too, to add to that, there's builders that wouldn't talk to us 6 to 12 to 18 months ago that are now reaching out to us just because, you know, they're seeing sales, you know, those long lists of buyers have, you know, diminished to single digits or non-existent, and you know, sales are starting to really slow. So I think everyone's trying to figure out, and Sudha and I really believe that this is, you know, this is going to be part of home building going forward. This isn't just a moment in time. There's going to be times in a cycle when the for sale retail buyer offers a much greater margin and a much greater option, and then there's going to be times when, you know, a rental community makes sense, and you know, we'll go through some of that affordability stuff a little later in the presentation.
All right, so just a quick few seconds here on build-to-rent market. So listen, there's been a lot of talk about supply. There's not enough supply of housing, and we'll talk about that at the end of the presentation, but we believe that building communities for rental works almost everywhere in the country, meaning almost every market in the country is underserved on the rental side. But as you know, I mean, investors like to invest in markets that have high population growth, high job growth, and that typically is the Sun Belt, right? We're here at the Sun Belt Builder Show because these are the areas where growth is occurring and we think will continue to occur. And so you've got folks leaving my state of California. I think everyone here knows that. They're leaving New York and they're going to places that are in the Sun Belt, right? That are more accommodating from a business standpoint. And so here are really some of the key markets. I know that, you know, a lot of what we've heard in the past is the smile states, right? It's sort of, but in the Northwest, things are expensive. So yes, it's happening, but not to the extent that it's happening in the Southwest and the Southeast. So, and it's no surprise that of the 34 plus communities we own, I'd say 32 of them are in the Sun Belt. We've got a couple in Chicago, but you know, that just, you can't deny that people are moving there. We see it in our leasing rates, and ultimately that's where capital usually flows. But the Midwest, Indianapolis, St. Louis, these are all places that Columbus, Ohio, that do have growth. It's nothing like the Sun Belt, but they still have a need for rental houses. Chris, you're up.
Yeah, so, you know, deal structures and entry points, I mean, I think, as Sudha mentioned, every home builder is kind of approaching this differently. And I think, you know, every deal is kind of different. I mean, the simplest thing for either home builders and or build for an operators like ourselves is just to go ground up development. You just buy raw land, entitle it, develop it, no different than a for sale community. I think some of the more unique structures too, another simple strategy is that a home builder does that, and then they turn, right when they're ready to start sales, they turn to a group like us, and we negotiate a contract to buy the whole community at some sort of pricing structure. So that's what we call a forward takeout, or a C of O structure, certificate of occupancy.
Now, just to add that there's so much here. We could give a whole presentation on just deal structures because there's a lot of nuances. So for example, I'm sure for those of you here who are actual home builders, it probably scares you to think that you're gonna lock in a price today for something that you're building over the next 12 to 18 months, given the volatility in costs. And I don't blame you. I mean, 24 months ago, it was much easier to do that with confidence. Now, I mean, that's scary, right? And so, as sort of investors in this space, we work with builders to create structures that really are a win-win, right? I mean, if you lock a builder in and their costs go up 20% and they can't share any of that with you, I mean, yeah, it's a win for us, but I mean, builders have to make margin and they have to make money. And so, the savvy groups like us that are continuing to work with builders are finding structures where there is some cost sharing, right? And it's sort of a win-win on if prices go up and if costs go up, that there is some way to mitigate that. And I think that that'll continue to evolve over time, especially as the market ebbs and flows. But I do think it's important for a lot of builders have been sort of scared away from build-to-rent because they just sort of couldn't get their arms around how do I mitigate my risk, right? So far, as costs have gone up, builders have been able to pass those costs on to home buyers. And that's been something that's sort of, I think, bailed everybody out. And that's gonna change, I think, over the next couple of years. I don't know that that's gonna be as easy to do. So I think I just wanted to add that there, Chris.
Yeah, and so, you know, in addition to, you know, a C of O structure, forward takeout, ground up development, there's also, I mean, hybrids of all these things, right? So, you know, there's structures where, you know, we get assigned the land contract and we close on the land, fund horizontal development, and then, you know, the builder comes in to fee build for us. So, you know, the structure, I mean, we have multiple structures with the same builder, so it's really deal specific, and the way we look at it is, you know, we really ask our build partners, what are you looking to achieve by this? What are your concerns? What do you want to do? And we kind of come up with a structure that works for that deal. So, you know, we have 15 different build partners right now, and we're in talks with many more, but we probably have 11 or 12 different deal structures. So the space is so new and it's evolving that you know, we're all learning together. So the deals that we, you know, struck 20 months ago, those structures are you know, ancient, you know, because so much has gone on since then. So we keep you know, we keep adapting and tweaking things as we move forward and working with our build partners. So specs. So, you know, I mean, listen, we like to, we kind of coined the term, we rent for sale houses. And what that really means is we want a builder to just build generally whatever they'd be building for the for sale market. You know, in some cases, we actually spec things up from the for sale market. You know, so, you know, generally what we're looking for is a more durable product. So, you know, LVP flooring throughout. You know, we're using a lot of the Shaw treads stairs for the flooring. We want to run, you know, the you know, even on the upstairs hallways, we want LVP. You know, I think the only place we'll generally prefer to do carpet is the bedrooms. You know, stainless steel appliances, hard surface countertops, all the things that are pretty standard on you know, kind of entry level for sale homes. That's what we're looking to do. You know, we also have, you know, some communities have amenities, some communities don't. You know, we have plenty of communities that are, you know, 50 to 75 units that are just homes, maybe with a little open space.
But for the industry, listen, the industry is going to evolve as it relates to amenities, but if you're a renter who used to live in an apartment building with density, when you move to a smaller rental home community, like a 75 home community, the amenity is the space, right? You've got the garage, you've got a yard, and as Chris said, a lot of these communities are sprawling, so it's there's a lot more space and open space in a community of 75 homes than in a typical apartment building. So I do think while it is nice to have amenities, and we certainly strive to with the larger communities, a well-located 75 home community doesn't necessarily need an amenity. I mean, there really is something to the fact that there's a yard and a garage and storage and general open space in the community.
Yeah, yeah. And again, I mean, if it was designed for sale and our residents want a for sale look and feel, so there's plenty of for sale communities that are under 100 units that don't have an amenity. So, we're looking to offer the same experience. Next slide. Yeah, this is just some more on specs. And these are just kind of generally the things that are offered in them. So yeah, I think we covered this.
Okay. Community amenities.
Yeah,
talk a little about that.
Community amenities. Whether we have a pool or a clubhouse, we generally I think there's been an arms race on the multifamily side of things where the clubhouses have gotten more detailed, the fitness centers and all those things. We generally don't. The difference is in a multifamily project, the average age in those communities are generally less. They're also generally not married. You have time to do those things. As you move into a rental community in a house, you generally have kids, larger families. So the idea of a fitness center and stuff is less attractive. I mean, the pool is always a popular thing if we can make it work. The paddle courts or not paddle courts.
Paddleball courts.
Yeah.
Pickleball.
That's it. Pickleball. That's become extremely popular, so we're starting to do some more of those. And so yeah, but as Sudha mentioned, the real amenity we're selling is the attached garage or the 2-car garage and extra bedrooms. So that's kind of really what we stress and what our residents are looking for.
All right, so housing supply. I mean, this is clearly a topic that gets mentioned over and over again, and I think this is one of the best slides that I've seen that sort of discusses the topic, right? You hear a lot about it, but I think the main metric here, Freddie Mac recently came out with an estimate that basically says, listen, we have a shortage of homes that's nearly 4 million. And that's up from obviously 2.5 million in 2018. So we're just not producing enough homes. Not all of those homes are rental homes. It's generally a shortage of 4 million homes across the country in different shapes and form. And a lot of that is because of the global financial crisis, right? There wasn't really homes built from 2009 to 2014 in terms of the entry level. And so that didn't help. And then now we're really catching up. We've got the supply shortage. So we've got the supply chain issues. So again, I think, and it's my hope that it's this lack of supply that will also create some sort of a floor on home prices falling, right? I mean, as much as it's not a bad thing in a very hot market for things to cool down every once in a while, obviously we don't want there to be too much pain in the marketplace because that obviously hurts every one of us. This is you.
Yeah, so the other thing is, the Freddie Mac estimates, those are just very broad, right? But I think what Sudha and I see and what we're looking to invest in is that in this country we've built kind of multi-family housing stock going back to the 70s probably, right? So and that housing stock has generally been heavily weighted towards 1 and 2 bedrooms. In the last 5 to 7 years, because of costs rising, you've actually seen the multifamily average unit size decline, right? You've seen more studios, smaller 1 bedrooms. So it's been very consistent as to what they're targeting in apartments. We've never, in this country, we've never built 3 and 4 bedroom rental product on scale ever in this country, right? It's generally been a more of a for sale product. So the largest demographic base right now in our country is the millennials, right? And they're generally in the young to mid 30s, and in a family growth stage. So the product that they actually need is a larger product type, and we haven't really been building that for the last 10 years. We haven't built it at all for rent in this country, but for sure in the last 10 years we have not focused on that. So what we're looking to do is deliver a product that suits that demographic and allows them to have space for their families to grow into. We generally want 3 and 4 bedroom units. We don't want anyone to move out of our communities, and the reason for them leaving is because they didn't have enough space. I mean, we own multifamily properties as well, and that's generally a large percentage of why people leave to buy a home, or because they need more space. So we're really targeting kind of a family renter and somebody that stays in a longer term tenant. If you think about it too, our average square foot on our single family homes is 2,200 square feet. Our average size on our apartments is probably right around 900 square feet. So apartments generally have a higher turnover, right? So if you're turning and renovating or fixing up a 900 square foot unit, that's not super expensive. If you do that same thing for a 2,200 square foot, that can get really expensive. So part of our business plan is that we need our residents to stay longer, because if we're turning those units every year, it's just not going to work. It's going to kind of break the model.
So these next few slides here, I think, are really interesting because and we've all heard, what does it mean? Affordability. Things are getting super unaffordable. Some of you may have personal experience with that. Others, I'm sure, are hearing it in the news and in the media. So, this slide sort of gives you a little bit of how things look, right? In the bottom are the sort of what would be considered affordable category, right? In that 25 to 30% range of your income that goes to housing is sort of what's supposedly normal, right? Average is there right in the middle, and then you've got the expensive markets, which are, for the most part in the Southwest, where costs are higher. But the next slide, so this is to me what's interesting. So this slide is as of March 2022, and rates started to go up, right? They just sort of started. You sort of see the blue markets are markets where it's more expensive to own than rent.
Oh, you didn't get it.
Oh, sorry.
Yeah.
And so what you have there, that's March of 22. So it was all, in many markets, it was already.
Yeah, so the blue is how much, by the amount, how much it is cheaper to rent than to own. So for instance, in Austin right now, in March, this is back in March.
This is March, yeah.
It was about $1,100 cheaper to rent than it was to own a house, and that's based on the run up in obviously home prices in Austin, and then those markets up top in the red, those would be markets where it would be still cheaper to own a home than it would be to rent.
And so you can see
this was just 4 months ago.
It was 4 months ago, but even 4 months ago it was already sort of becoming more affordable to rent, right? So now this is an updated slide. All those markets have sort of gone to the other side, except for one. And if you look at Austin went from $1,145, right? $1,145 cheaper to rent to $1,641 cheaper to rent in basically a quarter. So what is that really showing us? All this is showing us is the effect of rates going up. I mean, it just has become more expensive. That doesn't mean that individuals, there won't be any people that can buy, but it does show you the magnitude. And the reality is, unfortunately, that's really what the Fed is trying to do, right? They're trying to slow it all down. And unfortunately, it's not something that just happens overnight. And,
they're not really trying to make home ownership less affordable. I think they're obviously trying to pull excess capital out of the market by increasing rates.
And there's all kinds of byproducts. Of that,
I mean,
right?
Unfortunately, the byproduct of this is that we've had an extremely steep run up in home values over the last 2 years. So that combined with what, I mean, you just saw, how quickly mortgage rates have moved over the last 3 to 6 months. So that's like this perfect storm for home ownership where it's a compounding effect. It's not one or the other. It's both of those things working together to really increase the cost of owning a home in a very short period of time.
So I think I think we have a few minutes left for Q&A, but one topic that isn't in here that is sort of the ugly redheaded stepchild of this whole discussion is the regulatory side, right? You're hearing a lot about municipalities and cities coming out and sort of, thinking that rentals, there's too many of them, or we don't want them in our town, et cetera. And I think the industry right now, us as well as home builders, are really trying to educate the municipalities, right? Because at the end of the day, there's a lot of demand for these homes from people in the community currently and moving to the community, and that's something that I think over time will continue to sort of work itself out. But it is something that you're going to hear as the industry evolves. Yeah. And in addition to that, you're going to start hearing a lot about rents and rents going up, and the highlights now on the rental business. Used to be on the home ownership market and home prices appreciating. And I think now you're going to hear a lot of talk. The media is going to almost on a daily basis start focusing on rents. But the reality is rents have been moving for the last decade. But now I think it's sort of in vogue to start to focus on that. So I'm sure you'll hear more of that over time.
And I think part of what we try to do and educate municipalities and stuff is just about, hey, this is actually a way to bring more housing stock to the market. It doesn't hurt the for sale side absorption, so builders can, like we said, projects that were mothballing for 2 to 3 years, they can now bring them forward and partner with groups like us. Also, when in a softening for sale market, builders would stop building, right? So we offer that outlet to keep bringing and delivering units to market. I think also for municipalities, I think we've shown by the diversification of our tenant base, it's good to have this type of rental product in your community because it offers people the ability to stay in your community, right? Instead of somebody, a retiree who doesn't want to leave their community but can't find a house to rent, they may not want to rent a 20-year-old house. Like that's not, they just left a nice new house, and so that they want something really maintenance free and well maintained and professionally managed. So it's really about a diversification of housing stock in communities, and I think the other thing we tell people is that our residents are generally kind of $20,000 to $30,000 more than the median income in the community. It's not, we're not, with the cost the way they are today and values the way they are today, we can't build houses, for renters, by necessity. These are renters by choice because it's our rents generally are in the low to mid 2000s, and we have communities that have $3,000 rents. So this is and our residents are anywhere from 4 to 5 times. They can qualify 4 to 5 times. So these are incomes, 6-figure incomes on most of our residents. So I think unfortunately over the last 12 to 14 months, I think headlines about build for rent and all the money that's been raised and all the money that's going to it have just gotten out in front of what is actually happening on the ground. There's been a lot more announcements about things than there's been maybe money placed into these communities. So I think we just have to do a good job of explaining what it is we're doing and who our residents are.
So Lorraine, that's really the end of the presentation. I don't know how you guys do Q&A.
Yeah, we can. Sure. Yeah, definitely. We are looking at it from both perspectives. I mean, I think it depends on what type of structure it is. On development deals, we're trying to build to like an untrended 5 at minimum. That is evolving daily as debt becomes more expensive. So, it was compacting pretty significantly. Some of these stabilized communities were trading, in and around, upper 3 caps to mid 3 caps to low 4 caps. I think that's widening out to mid 4s to low 5 caps now. But we don't see an end in sight as far as interest rates go. So we'll see how that kind of continues to push out. Yep. Yeah.
So let me just repeat the question so everyone can hear it. I think what we heard was, what you want to know what the progression was from us going from investing in single family rental homes to communities. So that's the question. So it's part of our story, and it's part of sort of how we got there. So we started out, we built the business when it was a distress moment for single family rentals, right? Single families, we turned them into homes. When the market started to recover in about 2014 and 15, we went to investors and we said, hey, we just bought, X amount of homes, we're out of capital, we'd like to raise more. And they all said, well, I thought it was over. All the homes are back, the prices have gone up. And we said, well, yeah, but there's lots of renters for these homes and there's a return you can get for these homes. And they all said, well, we want the returns that we were getting. And we said, well, it's not that kind of business anymore. It's a true sort of cash flow business. And they weren't ready to think that in 2015 that buying homes at those prices and managing them was really a business long term. They weren't convinced that operators like us could actually manage these homes efficiently, right? Because when you're buying a home at market price in 15, there's no room for management error, right? Like an apartment building, investors understood how to manage those. They've been doing it for 30, 40, 50 years. There was a lot of data. So we ran into some trouble raising money and we said, we believe that this is a long-term business, but it's not gonna prove itself out for another 3 or 4 years probably. So instead of doing nothing, we continue to operate our portfolio and prove out that it could be done, but we added multifamily, right? We said, hey, we might as well join all these other multifamily investors and sort of do something that people understand and maybe it's a little easier and this, that, and the other. And so we started investing in multifamily, but we always had our eye on how are we gonna get back into single family rentals? And we'd go to investors, the multifamily investors, and we'd tell them, hey, you really ought to be looking at single family rental. And they'd all say, sure, we'll take a meeting with you. And we talked to them about it. And they'd say, so I got 300 or 400 million bucks. How do you buy houses? And we'd say one by one on MLS. And they'd look at you like their head was spinning. And then they'd say, fine, let's assume you could buy these homes. How do you manage them? And we'd say, hey, we've been doing it. Look at this, you manage it this way and the renters stay longer. And they said, oh, that sounds great, but we're gonna stick to multifamily. And so Chris and I looked at each other one day and we said, well, why the heck can't we just put a whole community of houses in one spot? And if we did, wouldn't all these multifamily investors think it was like an apartment? And he and I couldn't come up with a good reason why we didn't think you could do that. So we went and spoke to home builders and we asked them, we said, well, why the heck are you selling all these homes to homeowners? That's 120 or 200 homeowners you got to deal with. Don't you want to just sell it to one investor? And they said, well, that sounds too good to be true. And so they didn't say no, right? And that's the moral of the story is we said, all right, so it just hasn't happened yet. And so we sought out to go out and make it happen, and we're one of the groups out there that sort of made that transition. And I think the reason we were able to see it so quickly was because of our experience in both the single family business and the multifamily business. We saw how great the single family tenant was. We saw how efficient the multifamily markets were. And we thought if you combine the two, investors could get access to that great renter in a more efficient format in one location. And so that, I think, is what you're going to see is really the key driver of this industry over the next 20 and 30 years, is that development. But buying homes across a market is still a great business for those who can do it. It has its own merits, but I think it's inherently less scalable than sort of working at the local, at a single community level. Sure.
Yeah, so I think the question was if we rent our communities to renters by choice instead of renters by necessity, does it limit the areas that we can build these communities in? I think that, yeah. Okay, so yeah, I mean, I think that, I mean, if you think about it, right, you know, there's a minimum cost to building a home these days. Forget, even if the land is zero, right? It's really hard to build a single family home under $250,000 today. It's just not possible. So, you know, when we're talking about building new communities of homes, I think you know that you're going to be limited. We're already limited to certain areas because there's a minimum amount we can pay a builder, or there's a minimum amount a builder would accept too for a community, and so that's, you know, I mean, it used to be like $200,000 to $250,000 used to be a good number, but then, you know, it's probably more like $300,000 to $350,000 on the low end now. So, in order for us to get that return, you know, our rents are generally in the $200 to $2,300 range. So yeah, I mean, there's only certain areas. I mean, it's just like multifamily, right? New multifamily doesn't get built everywhere. I mean, I think there's certain reasons and certain opportunities to build it in certain areas, but for the most part, our communities are, you know, in areas where the tenants can afford it. You know, generally in median household incomes of $60,000 and greater, and you know, that sort of thing. So, but I mean, I think everyone's struggled to figure out how to add new affordable.
More workforce,
more workforce housing.
But I do think over time the industry will evolve, and they're just like there's affordable housing components to multifamily. I think absolutely there will become affordable housing components to the single family rental business. No reason why families can't and shouldn't live in a home. But I think as this business evolves from where we are today, it's going to be focused on where the economics work for both sides. Yeah, that's a really good question. So he asked, when we go out and work with builders to acquire communities from them, do we pay a market price, or is there an inherent sort of bulk discount that we ask for? This is like everything, there's a market, and the market has evolved, right? So I think there was a moment when the for sale market was not as strong, and builders sort of looked at us, the early movers who were willing to work with groups, looked at us and said, yeah, I'm totally comfortable giving you a discount, and because I'm selling all these to one person, eliminates a lot of my costs and takes my risk off the table and that sort of thing. And
sometimes that discount was just as simple as backing out sales commissions, backing out marketing costs, backing out the cost of a model unit. So, you know, that ended up maybe equating to like a 5 to 7% discount on where they thought they were going to sell.
And, you know, as the retail market got stronger, as costs started to move, then obviously that market in their analysis changed, and so did ours, right? So then you started looking at getting much closer to some sort of cost sharing program, and sort of some price that wasn't a substantial discount. So I think it ebbs and flows, but at the end of the day, builders should look at a group like us from an economic perspective and a risk perspective and run their own numbers. They shouldn't be shortchanged, right? If they're going to do a deal, they've worked really hard to put a deal together, a community together, they should be exiting at a really fair price from a risk perspective. So they shouldn't be leaving too much money on the table either way, but should look at the risk profiles of both as well. Sure. So this will probably be Chris, but the question is, can you touch on the specs that you see in some of the communities that we're buying, sort of the interplay between things like tile and carpet, and probably laminate flooring versus hardwood or carpet, things of that nature?
Yeah, I mean, I think generally, it depends on the community and the spec level. We have some communities that are a little higher end where the bathrooms will be, instead of fiberglass inserts, they'll be tile, walls and stuff, and tile surrounds. Generally, our base level spec is the LVP on the stairs, on the hallways, on all of the first floor, with carpet in the bedrooms. Tile, fiberglass inserts are fine on the baths. We like to have at minimum granite countertops, for sure, in the kitchens and the secondary baths. We'll do some cultured marble in the secondary baths too. Some of our communities a little higher end have some quartz. Generally we do tile, 3x6 tile backsplash in the kitchens. Stainless steel appliances. We generally don't put in washer dryers. So similar to for sale, some of our residents are moving from where they own their washer and dryer, so they generally can bring their own, or so we don't usually offer that. That's pretty much our spec level. I think the question was, what kind of cap rate are we looking for when we do when we evaluate a subdivision? Are you saying what exit cap rate, or what is our going in? What's the going in cap rate? Yeah, I think like I said, it's definitely in flux. I'd say initially when we were underwriting these maybe 24 months ago, we were in the 5 to kind of 6 range. I don't know that we got up to 6 ever, but maybe. But in that range, I think it then, over the last 12 months, it tightened probably to like a 4.5 to sub 5 range. I think as I mentioned earlier, I think that's widening out a little bit more now. So it's on the development side, we've been pretty consistent that we're not going to go below a 5 on untrended. But I think we're probably in that range on some of our other communities too.
Your expense ratios for your single-family home development different from multifamily apartments?
Yeah, that's a really good question. So the question was, are our expense ratios on our single-family rental communities different than our multifamily apartments? The answer to that is yes, and they vary in different ways. I mean, I think the overall expense ratio may be fairly similar. I mean, the expense ratios,
Mid to high 60s.
Yeah, and I think the biggest thing that affects the expense ratios are the taxes, right? So if you think about Texas, Texas has low taxes for everyone other than property owners. So we're a property owner. So we generally, Texas is a very high a high expense ratio market due to the taxes, and so We generally try to get our expense ratios in the 65 to 70% NOI margin range. We can get that, some of that a little similar on multifamily sometimes, but it's different what varies. So like the turnover in multifamily averages anywhere from 40 to 50%. So that means 40-50% of your units you're renewing every year with a new lease. On the single family side, that turnover declines to kind of 30 to 35%. So we're only a third of our properties are turning over every year, or our tenants are staying about 3 years. So, so things that but our turn costs are greater on the single family side. So you generally get the overall expense ratios in the same range, but the reasons for getting there vary between the single family and the multifamily.
So your expenses, you're thinking about 35% of your gross rents?
Depending on the taxes.
Yeah.
We
tax
don't
market.
get we don't get 35% expenses in Texas. It's greater than that. No, it's high. Texas would be higher. South Carolina's higher. Places where the tax burden on the property is greater, our expense ratios are not as good as some other markets. Like Phoenix, for instance, has very low taxes, so we're achieving kind of 30% expense ratios there.
Any way to make your hurdle rates on more expensive properties, like say $600,000 homes? Have you looked at that?
Yeah.
I mean, it's a niche market.
Yeah. So the question is, does this work? I think in higher priced homes, 600,000, move up housing. So, I would say the bulk of our portfolio is probably in the $200,000 to $400,000 range. I would say that makes up probably 80% of our portfolio. We do have a handful of communities that are $400,000 to $500,000. So I think our most expensive community right now is probably in the low 500s. In order for a $600,000 home or a community to work, you're going to need rents probably in the $4,000 range. So, I'm not saying that doesn't exist and there's not demand for it, but you're right. I think it's a thinner market up there. Every one of those people can afford a home, and it may actually be cheaper to buy a home at that level, depending on what you're buying. But
I think in the right neighborhoods,
yeah,
there is a need, but what investors like us get nervous about is how much of it is needed. So if we build one and our 80 units get leased and someone else builds one and someone else builds one and now there's 3 of them, is there enough demand at that price point from that group of that demographic? Most of the time it's located in great areas, great schools, great incomes, and that's what draws us there. But this whole business works if those homes are not being turned over as frequently. And so if those folks are going in those homes and then leaving every year, then our business model will fail. So our concern in those markets would be how deep is the rental pool, and are they truly going to stay in that home like a normal single family renter, or will they turn over more often? But you'll see more and more over the next 2 or 3 years pop up in those types of markets. But Houston or Texas, again, the taxes are going to make it difficult because those rents have to be even higher than if they were in Phoenix or Denver or Atlanta or somewhere like that.
Yeah. So the question is, we're generally looking in tier 1 markets, but have we looked at and are there groups like us looking in tier 2 markets? And the answer is yes. So we have communities in Knoxville and Chattanooga. We have communities in Huntsville.
Greenville.
Sudha calls it our Ville strategy. markets that were not necessarily institutional markets, and I think we hit on this earlier. You know, there's an undersupply in housing everywhere, and this does work everywhere. Just like,
and arguably, some of these secondary markets may be better, because you're not going to have the supply, right? I mean, folks like us like to go to places like Charlotte and Nashville and Atlanta and Austin and Dallas and all the big names, and eventually those markets do get overbuilt. They have great demographics, and everyone looking at them on paper feels like they won't lose their job if they go invest there, right? But you take a flyer on Knoxville or Fayetteville or Huntsville, and you're wrong, that you might get in trouble there. But when we go to these markets, demand is through the roof, there's not enough housing, and the rental rates are sometimes the highest in those markets, believe it or not.
Our highest rental rates right now are in a community in Chattanooga. So, like $3,500 rents.
So yeah, if any of you are considering secondary markets, or you live in one and you feel like there isn't enough, I would seriously not get held back by all the naysayers. You're probably right. There is an opportunity there. So. All right. Looks like there's no more questions. So.
Yeah. Well, thank you guys all for showing up. Really appreciate it. Thanks.